The major issue around quantitative tightening for the US economy is that as that's rolling off, it has a major effect on mortgage interest rates. So a lot of the securities that are rolling off are mortgage-based securities. And so whilst we've got a higher interest rate, risk-free interest rate, we're also getting widening in that mortgage spread. And so that means for Joe and Jenny Average in Nebraska, they're being asked to put pull a lot more money out of their pocket to fund their mortgage obligations. Now, we are seeing a slowdown in housing in the United States. We are seeing, if we look at the home builders index in terms of equities, that is out and out in bear market territory. New home sales are down over 20%, prices are slipping. So all of these types of lead indicators are showing that there's a tightening, and we can combine that with, we know that the fiscal drag starts to run off, plus we've had a very strong dollar environment. And you can see that financial conditions are really starting to tighten. I guess the other ones that we look for is that volatility in the equity markets and wider credit spreads, as we touched on. So, all in all, 2019 looks to be a very, very interesting year where, in many respects, as we often say, the dominoes are lined up. The sequencing of how they'll fall is very interesting and the timing around that, but I'm pretty sure that they will fall at some point as the year progresses and things get harder. That is a bit of a bearish outlook for the United States, but when we go on these rate hiking cycles, you've got to remember that we're hiking, at the start of the cycle, we're hiking because things are going so well and we need to come away from accommodative. But towards the end, we are finalising on the inflation mandate and going into restrictive territory. Now, anybody that drives a car knows when you jump on the brakes, things slow down quite quickly, and the Federal Reserve are jumping on the brakes as we head into 2019. The global economy, it was only a year ago, we were talking about global synchronized growth. That lasted for what, all of 3 months, and all of a sudden emerging markets are in turmoil via a strong dollar. There is something like $26 trillion worth of international US dollar-based loans, and so clearly as the dollar gets stronger, that becomes more expensive to fund out of a domestic currency. Some of it, of course, is swapped, but a lot of it isn't. And we've seen, the problems with emerging markets over 2018. That's unlikely to turn around quickly. The ground that they have been standing on for so long, being very low interest rates, cheap borrowing, and excess liquidity, has disappeared. Quantitative tightening is taking away that excess liquidity. The cheap interest rates are gone and they are getting more expensive. And the thing that we've got now is we've got viable alternatives. Those short-dated bonds in the United States are now very, very attractive as a risk-free asset holding. And so we're not seeing the same levels of financial tourism as we were under the oppressive quantitative easing methodologies where people were forced to find income and yield. Income and yield is now available in treasury bills or short-dated bonds. And so there are really alternatives where there haven't been for more than 10 years. Well, clearly equity markets, we try not to comment too much on equities. We're not an equities expert. A lot of equity guys like commenting on bonds, but we don't return the favour often. But clearly, as those risk-free alternatives become more attractive, there becomes a sponsorship problem, and people look at the market volatility that they've experienced and think, how much more upside is there in this cycle? I think it's fairly clear to see that the cycle will come to an end at some stage in the near future. How quickly and how asymmetrically that plays out is the source of great debate, and what those real triggers will ultimately be. But as the Federal Reserve continues to tighten and tighten and tighten, and we can't keep spending fiscally like we have been, the Democrats simply won't allow it. We need to keep feeding this monster. When you get yourself into this fiscal deficit situation, unless you can continuously keep throwing money onto the fire finally burns out. And that starts to happen in the United States in 2019. So some extraordinary spending package of infrastructure or the like. It seems unlikely the Democrats would be in agreement to that. It would certainly help Trump into his 2020 re-election program. And that's the last thing they want to do. They want to lock him up, and they literally want to lock him up, and they will try very hard to do so, I'm sure.